Just give it another couple seconds here. And we'll get one or two more in, I see. Excellent, excellent. Well, welcome, folks. I'm glad that you've attended. Okay. Well, let's get this show on the road here. This presentation is being recorded. I'd like to again welcome everybody. This is going to be a webinar for the 2023 Market Outlook, and we will be discussing a number of topics tonight. First of all, I want to introduce myself. My name's Tom Mitchell, and I have the honor of leading the 1AZ Wealth Management team of wealth advisors located here at the 1AZ Credit Union. Our full-time professional financial advisors are assisting clients and members of the 1AZ Credit Union all over the great state of Arizona. We are very excited to bring you these educational topics directly to you, and we are planning many more later in the year. We have topics lined up on Social Security, Medicare, women in investing, and many, many more. Actually, as a heads up, our very next webinar will be on March the 7th. You might want to make a note of that. March the 7th, we'll be doing one at noon and one at 5 o'clock. Noon and 5 o'clock. The title is going to be 11 Common IRA Mistakes People Make. Plus, we will share some highlights about the new Secure Act 2.0 and how it is actually impacting everyone's retirement planning. Then email invites for this future webinar will be sent out in the next week or so. So be out there looking for it, and also mark your calendar for March the 7th for that event. First, here is our information page. It contains our required legal disclosures for your convenience. Please always check out our 1azwealth.com website for other upcoming webinar events that we'll have for the rest of the year. Now, for better audio, the webinar will be in listen-only mode. We will be fielding your questions at the end of the webinar. Please email your questions to 1azwealth@1azcu.com, and we will be compiling your questions and answer them at the end of today's presentation. If we don't get to your question, I promise we will respond to you personally. We received a whole bunch of questions over the earlier webinar, and some even for this evening already. So we will be addressing as many as we can today. But again, if we don't get to all of them, we will follow up with you individually. Last, for more information about 1AZ Wealth Management and the team of wealth advisors, I urge you to visit 1azwealth.com, or you can use your mobile device right now to scan the QR code that's on the screen right now. You can also connect with us on social media, on Facebook, LinkedIn, and YouTube for more exciting resources and helpful information. So let's get started. On our 1AZ Wealth topic today is on the 2023 Market Outlook. We have Robert Nichols, one of our more senior wealth advisors, as our main presenter today. Bob has over 25 years of industry experience, serving clients all over Arizona since 1996. Much of his career has been specifically actually focused on helping credit union members with their financial planning and investing needs. He has been with LPL, registered with LPL for over 20 years. Bob is a graduate with a bachelor's degree in finance from Arizona State University and works with his clients as a fiduciary, having also obtained his AIF designation. AIF stands for Accredited Investor Fiduciary Designation. Here's our agenda for today. To understand 2023, I think it's probably important to highlight how we got where we are today with the 22 now behind us. Many, many lessons we can learn from the unprecedented events of 22. So Bob, let me turn it to you. Why don't you take it from here?
Great. Thank you very much, Tom. Yeah, as you say, unprecedented. A lot of people heard, what was going on with stocks in the stock market, but a lot of them had not heard what had gone on in the bond market. And most people that have a diversified portfolio have a blending of both stocks and bonds. Prior to 2022, Treasuries, government bonds, had been going down since the mid to late 70s and had gone down almost continually through 2021, 2022. A lot of people hear back about treasury rates in the 70s getting 15, 16%. Here we can see the 10-year treasury at almost 16%. It had gotten down at the end of 2020 to 0.93, 16% to 0.93. It's now currently at about 3.64. So we've seen quite a bit of a rebound in that. Also, as if you were with us at the beginning of last year, we did one of these webinars, and we had talked about how elections can be choppy. Mid-year elections can be very, very choppy. And this shows what the average returns are in those markets, and then also how much they can drop prior to the election, intra-year drawdowns. And we got that big time last year. We got started with the stocks at almost all-time highs at the beginning of the year. They bottomed out close to about the election, late October, early November, but we didn't get the expected rally out of the elections. That may be that there were still some of them that were unsettled for a period of time. So we didn't really get the post-election rally or the Santa Claus rally that we usually do, but we did get that very, very choppy market. And it was unusual for us because a lot of times we have seen the markets be very, not volatile, at least in the last few years. Tom, on the next one, we show what the average annual returns have been for the S&P 500. And this is going back to 1980. It shows that most years have been positive. We've had a few down years. You can see in the middle there, that was 2001, 2002, then in 2008. But the bars are where the year ended. The red numbers were the biggest drop intra-year. And you can see that last year we ended up almost as far down as the market dropped all year long. So we did have a little bit of a rally coming out of December. We've seen a nice rally so far in January, but it was just more worrisome because we had a prolonged period of low volatility before that, as shown in the yellow area, that we didn't have the big drawdowns, maybe 1 year out of those last 4 or 5, but a lot of them were pretty steady with some very, very good returns in there. One of the things that got markets moving last year, or at least stocks to the downside, was that stocks had gotten a little bit overvalued, had gotten expensive. If you look, this is a tracking of what's called the PE ratio of stocks of the S&P 500. This is how we can compare stocks in different industries, is compare their price to their earnings that are expected. Over the long period of time, the average of the S&P 500, the 500 companies that are in there, that average market multiple or PE ratio was about 16.5. That means that for every dollar of earnings they have, you would feel comfortable paying 16 times that amount. So if they had a $1 earnings, you'd pay $16.5. We can see on the far left that that had gotten into the 20s, over 22 times of what people were willing to pay. So stocks had gotten very expensive. And a lot of that was the run up in some of the technology stocks. We saw last year the run down in what people were willing to pay, not the earnings so far, but what people were willing to pay. They were not willing to pay up as much. So the average of what they were willing to pay got down to 15.5. You take that 22 minus the 15, that's about a 30% drop in what people were willing to pay. And that's about what the stocks went down last year. So most of it was just that market contraction. But then when you look at bonds, bonds are tracked by not only treasuries, but also by the US bond aggregate, the Barclays aggregate. And if you look at the yellow, that shows how bad bonds were last year. So the average person with a 60-40 stock to bond portfolio, hoping that stocks go up when they're good and bonds will be okay. And when stocks go down, bonds will be that safe harbor from the storm. We didn't get that last year. We had stocks dropping and we had bonds dropping almost as much. If you look at, the 30-year treasury, the value of treasuries from the beginning to the end of last year was down 31%. The NASDAQ was down a little bit more than 30. So there was just no safety for even conservative investors because bonds were going down just as much as stocks were. So that's what I think scared a lot of people, was they were not used to the bond portion of their portfolio going down. And if we look at how historically bad it was, on the next slide, it shows that the worst year prior to last year was back in President Reagan's first year in 1980. And that year, bonds had dropped twice in a row and down a total of 16%. Last year, we were down 16%. So the first time that we were down more than 10% in bonds in a year in 40 years, and we were down twice as much as the previous year. So I think it doesn't get reported as much, but people were much more concerned that thought they were conservative, and bonds were just not the safety that they have been in the past. But bonds only go down for a certain period of time because it's usually a reflection of interest rates. And the Fed had been raising interest rates very, very rapidly to fight off inflation. And inflation, it surprised us big last year. The early year, Fed was talking about transitory, and then it became a little bit more permanent. You can look at this slide and see the blue line is a tracking of the 10-year treasury yield since the 1950s. It had gotten high in the 70s, as we discussed. It had dropped down for 40 years and spiked up. The gray line is what people actually realized after inflation. So even in 1981, when the 10-year treasury was at 15.8, the real rate of return that people received off of that was a negative 5% because inflation ate away faster. We saw that come back into play last year, where the 10-year treasury in September was 3.8%, but the real rate of return after inflation, what people got to keep and what was spendable, was a negative 2.5. And that was just not something that we've been used to. And it was something that kind of came out of it at us really fast. And even here in Arizona, we felt it a little bit more.
Well, that's so true, Bob, because inflation here in Arizona was extremely high compared to the national averages. We were experiencing much more inflation than others all over the country.
Yes, and part of that, you're absolutely right, was food, energy, and housing. And we look at the next slide, and this talks about CPI, the Consumer Price Index. And this talks about how prices track, and the difference between headline, the blue line, and core, the darker line, is that headline is subtracting out food, energy, and housing. What they do, instead of using the current number, they use an averaging number from the 12 previous months, a year-over-year averaging. So for a lot of us, we were seeing prices going up, and the Fed was looking at trailing numbers. So if we looked at where gas prices are right now, they're still averaging in gas prices where they were a year ago. So that's where it took the Fed longer to start raising rates, because they were looking at trailing numbers in a lot of these areas that are very volatile. And they weren't looking at current or future numbers. They were just looking at the past. And that's where it took them a little bit too long and made them raise rates much quicker. But that's one of the reasons we felt it here in Arizona, and especially because of housing prices.
Inflation truly does eat away at our assets and our income, clearly when we go to the grocery store. But inflation has been around for a long time, hasn't it, Bob? And we just have to recognize it's here to stay, but we have to manage around it.
It has. It's been here. It had just been tamed for a period of time. And a lot of that was just because of the Fed keeping interest rates mainly artificially low. But yeah, it had been in a range for a period of time going back from the 80s when the Fed President Volcker had started fighting inflation. But it has recently got away from us, and we'll discuss that in a few minutes, some of the reasons. But the next slide is a little bit of an illustration of how inflation has eaten away. If you look back in 1964, I know that's a long time ago, but $100,000 on a 6-month CD would get you 4.3%. That'd get $4,300 a year. That would buy 2 brand new Mustangs at that point. You know, you fast forward to 2021 and a 6-month CD, even though they're not 0.14 anymore, they're closer to 1.7. That would have gotten you $140, and now it gets you about $1,700. But it would that 140 would get you 2.5 tanks of gas, not 2 full Mustangs. So it just has shown that it's eating away. And people that have thought, well, I'll be very safe, I'll take money out, I'll put it in cash, or I'll put it in savings. If inflation's 6% and your savings rate's getting you 2 or 3, you're still that money is losing value, and it can't recover that lost value. That's where investments can still get you, you know, some better returns going forward.
So true.
Yeah. And this is now the Fed funds rate. What did the Fed do to fight inflation? They can do one of 2 things. The Fed can raise the Fed funds rate, which is the interest rate that is paid to banks to hold their excess reserves. Where it affects people, and right now that Fed funds rate after the last increase is 4.75%. You can see until early 22, that was at 0 and had been at 0 for a couple of years. It had gone up a little bit, up above 2% from 16 to 20. But even from 16 back to 2009, we'd been at 0. So over the last 13 years, except for a 2 or 3 year run, we've been at 0% interest on the Fed funds rate. And now they raised it within 8-9 months from 0 to over 4.5%, which is historically very, very fast. The blue dotted lines right now are what's called the Fed year-end estimates, or the plot, the dot plots. They right now are sitting at about 5.1 is where the Fed thinks they'll end up. The green dots, or the market survey, they're thinking that they'll stay right now at about 4.75. The second way that the Fed can fight interest rates is what's called their Fed balance sheet. Now, the Fed balance sheet is the amount of Treasury bonds and mortgage-backed bonds that they own. It had gone from 5 trillion before COVID to almost 9 trillion at their high last at the beginning of last year. $9 trillion was their balance sheet. Now, that is money that is added into the economy by the Fed buying bonds. It gives money into the public or into the economy. They said that they were going to start lowering that balance sheet, or their bond portfolio, but they only went from about 8.95 trillion to 8.55 trillion. They only dropped it by 4%. And we feel that that is a more effective way to fight inflation than the Fed funds rate, but they've insisted on just using the Fed funds rate instead. And they're still right now at about 8.5 trillion in their balance sheet. So,
you know, Bob, earlier on our prior webinar, we had some people ask about this huge spike, right? Just look at this spike right here that took place. Well, when does that take place? That took place during COVID, right?
During the first few months of COVID, a lot of it.
Yeah. And that's the stimulus monies that were added. And those stimulus monies continue to grow. And that is like a pig, as I call it, the pig in the python. We've gotten so much dollars, so much money in the economy that it has to be digested now.
And that's exactly, it either has to be, digested, evaporate over time, or it has to be withdrawn. And that's one of the things when we look at what are the causes of inflation, this was really a lot of money injected into the economy, a breakdown of the supply chain. You remember that there weren't things on the shelves, couldn't get rice, couldn't get beans, couldn't get refrigerators, washing machines, couldn't get cars. There was so much that was not on the shelves, except for you could still get a lot of stuff delivered. So people were at home, they've got extra money, they're spending it on fewer and fewer goods. So Econ 101, more money, more personal demand, less supply, prices have got to go higher. And that's what ultimately happened was prices went up, and they're staying up because that extra money injected needs to be absorbed.
Exactly. Let's talk about this yield curve now.
Yeah, the yield curve is, a chart of the different yield rates along from 0 months to 30 years. So in December of 2021, it was a normal yield curve where the far end on the left is the short term, and the end on the right is the long term. So you go from 3 months out to 30 years, and it's a nicely sloping arc. Usually the rates are a little higher, but it's nicely sloping. You look where we were in September, and all of a sudden the 2-year, the 5-year, the 10 it had spiked up. So now you went from 0.39 or 0.73 to 4.25 almost on those. At the same time, yields at the long end went up, but not as much. So now the 2-year is above the 30-year. And I was just looking right now, the 2-year treasury before this was 4.475, and the 30-year was 3.679. The
Wow.
2 years almost 1% higher than the 30-year. So you get more money to wait shorter than you do longer. And that's what is called an inverted yield curve. And that generally predicts a recession going forward. The other thing that predicts a recession is negative quarters of GDP in domestic growth, the economy growing, and that contracted in the first 2 years. And then a market sell-off can sometimes predict. This is showing, and it's not showing any specific period of time. It's showing the normal time of a recession. The blue is the S&P 500 and how it reacts. The green is industrial production or domestic production. You can see that when on the red dot on the blue line, that is when the market peaked and started to sell off. The circle on the green line is where industrial production peaked and started to sell off. So the stock market predicts a recession by 6 to 9 months, and that's what happens normally. Then you can see the second red dot is where the market bottoms out and starts to recover. And that happens prior to economic production starting to recover. So the market sells off before the recession and it recovers before the economy recovers. And that's what we're hoping, or right now we are expecting. Though it will be the National Bureau of Economic Research that'll come out in a year or so and tell us exactly when the recession started, when the recession ends. If we're in one right now, I do believe that we're at least beginning of it, if not already in. But that's one of the reasons also that we started to see stocks sell off about a year ago and intensify after June in July when we had that second consecutive quarter. And I think that was a lot of expectations of people saying we're getting into a recession, let's start to take some risk off the table. It just, if they moved to bonds, it didn't really help.
Exactly.
But there are a number of economic sectors that the Bureau of Economic Statistics looks at, and that's both consumer, that's business activity, and financials. And you can see where we were mid part of last year, and the green arrows are where things were increasing. The yellow is where they were kind of stagnant, and the red X's are where things were declining or regressing. And in June, we were a little bit balanced. The overall signal was still green at that point. Move forward, things slow in July and August. By November, we're almost all red. We've got 2 green arrows and 2 yellow. I just looked at the same chart yesterday. The housing permits is now red. The jobless claims, we're still seeing unemployment go down and employment numbers go up. But the other one, trucking shipments, that one is almost in the yellow, just barely in the green, but that goes along with those retail sales. And if retail sales are slowing, we're also going to see trucking shipments more than likely slow. So the next one shows where we have been on these same charts before different recessions. And before the recession start, with the exception of 2020, most everything was either all red or mainly red and yellow. So that's telling us that we're on the decline right now. 2020 was different. That was COVID. We shut everything down. Still, things were moderating right then, but now it's looking like we're heading more towards a recession. And will the Fed be able to kind of get that soft landing? One of your favorites, Jeremy Siegel from Wharton in Pennsylvania, said that this is one of the most anticipated, talked about, predicted recessions in history, because so many people are forecasting it and so many people are talking about it that, you know, it can't come as a surprise. Everybody's even debating whether we are or whether we're not in one, not whether one is coming.
Yep.
Now, we did have an election last year. It did take a while to shake out, but this is what we've looked at is going forward after, you know, a midterm election. There's two things that can happen. We either have a Democratic president or we have a Republican president. The Democratic times are listed in blue. The Republican times are listed in red. The other is down at the bottom where the blue with a Democratic Congress, or the blue in the middle with a Republican Congress, or the blue with a split Congress. Same thing for Republicans on the other side. Right now, we have a split Congress. We have the House being controlled right now by the Republicans and the Senate controlled by the Democrats, and we have a Democratic president. But historically, going back 60, 70 years, this shows that this is one of the better times for the markets. That overall is averaged a return of about 16% long-term in this situation. Now, also after the midterm election, the returns going forward 1 year. So from November of the year of the midterm to November the year after the midterm, going back to 1950, if a Democrat was president, the average return on the S&P was 14.5. If a Republican was president, the average return was 14.8. Either one, the average return was 14.7. So that would give us encouragement that through the end of next year, or through next November, that we are hoping, given normal markets and given, you know, normal times, that we would see a positive stock market over that period of time. But you know, that all has to do with fiscal stimulus, and it also has to do with earnings numbers, but at least the history is with us.
Yeah.
Now, the other side of it is the bond side. We've talked a lot about, you know, stocks and what they do. This is where bonds are at. So if you look, income has been coming back. With higher interest rates, that is good news for bond buyers of new bonds. Those yields that they are receiving are higher now than they were a year and a half ago. You can see recently the low on municipal bonds, which are very popular, was, you know, less than 1%. Now in November, they were at about 3.5%. Right now, they're close to 4%. But that's, you know, a dramatic jump in what the yields that those bonds are paying, and especially municipals, which those are federally tax-free. And if it's an Arizona bond, that's both state and federal. But also, if we start to see bond or interest rates come down, that's also good for bond prices. So where we look and see when interest rates were going up on the next slide, in December, we can see the green bar is where bond prices were on average. Bonds are priced on the new market at par, $1 for $1. You can see municipals had gotten to $1.12, so a 12% above market valuation. You look at corporates, they were at 109% of value, even high yields at 102, and how far they've dropped through the end of July. Now, when the Fed started slowing at the end of the year, instead of doing 75 basis point increases, they slowed to 50 and now slowed to 25. Those bond prices have crept back up so that right now municipals, instead of being in the 94, 95 cent range, are back towards 100, 101. So you're getting a little bit of a bounce back in prices from, you know, from the Fed moderating, and we expect that to continue. One of the reasons we like municipals is that states right now have an awful lot of cash. They've received money from COVID that may or may not have gone to COVID. A lot of it, even here in Arizona, we saw went to some of the government employees, some of the teachers. We've seen some of the other states have a lot more cash on hand. We're getting money not only from the federal government, but also from property sales taxes. We're getting it from sales taxes for goods and services. States have built up their rainy day funds. They've built up their pensions. So they're in fairly good shape right now. And that's where we like, if we're looking at municipals, we like to look at national municipals, not just Arizona. Arizona, we think is great, but everybody knows we've got the big game. I'm not even know if we're allowed to say the trademark name, but that's coming up this Sunday. Right after that, soon is the draft. And what would it be like if the Arizona Cardinals could only draft from Arizona schools? They would be at a disadvantage. They want to be able to draft from all over the United States. Same thing. If we're looking at a bond portfolio, do we only want to be Arizona bonds because we get both state and federal tax free? Or do we want to buy from states that may have a little bit better cash, a little bit more solid footing, and be able to buy the best of quality and diversify?
Yep, very so. This is, as I was looking at this chart earlier, Bob, it's nice to see how many states we actually are there. They are in good health financially, so that a national view of munis is a good way to look.
Absolutely, yeah, we're reading a lot of good things about them, because not only do they like them for being tax free, they sold off a little bit more, and they are not all that correlated to the stock market. Usually, you can see on the far left the blue diamonds, those are treasuries, and how uncorrelated they are with the stock market, which the further to the right you go, the more correlated. 1-to-1 means if the stock market goes up 1, bond market or those assets go up 1. Munis are right in the middle. They're not really correlated to the market, but they give a good return. They don't have a whole lot of risk. And if we can get a little bit of a jump out of the price and a 4.5 or 5% tax-free yield, I think munis are a very encouraging, attractive area.
Very much. Well, let's see now. We've talked a lot about 22. We've talked about the effects of inflation, the effects of what's happened with the money coming into the system. We've been talking about where yields are, where they're looking to maybe go, and having rates soften up a little bit, maybe towards the end of the year. Let's talk about the economics of the markets and what forecasters are saying for next year.
Yeah, forecasters, they're pretty wide range. You've got some that are looking at the S&P 500, the final number for the S&P 500. You've got some that are predicting as much as 4,500. You've got some that are predicting in the low 3,400, 3,300, low 3,000. So right now, before we did this this morning, the S&P 500 was about 4,128, 4,128. So that right now is about in the middle of where a lot of people are. That doesn't mean that the S&P will go straight up to 45 or straight down to 34. We're expecting some choppiness in the beginning of the year, but then a rally towards the end of the year. These forecasts. You're from Pennsylvania, as we said, Puxatawny Phil, Groundhog Day. I saw the numbers the other day that said he's right about 40% of the time. I think that's a lot like these analysts that, if anybody had the right estimation each year, then only everybody would look to them. But a lot of times these estimations are put out there to, make weathermen and, fortune tellers look correct. But even Stephen Hawking said that there's only one way you can predict the weather 6 months out, and that's by just giving the seasonal average. And that's what I think a lot of these estimations go back to is, oh, okay, well, we see the market growing up by about 7% or 8%. That's where our number will be. Some of them are saying, I don't think it's going to be a good year. Bad year, and the market is down on average. And I think this is just more, nobody knows. Well, that's where to stay invested. Always. We can't say, well, this is a good time to get in, let's get in now, or this is a bad time, let's get out. If you have time to invest, stay in there.
Stay invested. And actually, as we always like to say, Bob, right? volatility can be your friend, because
If you're adding to the
volatility
markets, yeah.
it gives us the opportunity for buy-ins at lower prices as things continue to rebound. I'm very interested in looking at this slide is that you just said the market's closing at about 4,100 right now. And if you look at the average of all these forecasters for the year, they're forecasting 4,000, right? So we're actually above what's forecast, or above what the forecasters are saying currently right now on average.
Yeah.
But I think the fact is it's going to be a choppy year. And I think that's something we want to make sure everybody recognizes, that it will be choppy, and that's our belief. But I believe also that's going to give us great opportunity over this year of getting some good buys and then building up more and more holdings through those good buys.
Yeah, and that's the other thing about on average. I was talking with somebody the other day that said, if you were living in Iowa right now and you were at 7 degrees and you looked and said, hey, why don't you move to Arizona? The average temperature year round is about 73 degrees. That sounds like a great no-brainer. They don't talk about the 110, 120 days of over 100 temperature that gets us to that average. So yeah, there are going to be good days. There are going to be good bad days. There are going to be good months and bad months. But over the long period of time, stay invested. You've said before that most people don't realize they're taking too much risk until they've taken too much. What we want to do is make sure that portfolios rebalance on a regular basis, so that if your winners grow, you rebalance those. If your losers are down, you rebalance those. You get back to your targets, so that you're not just, expanding, contracting, and not moving anymore. That's just being on a treadmill. So that's where we really want that rebalancing to take place, and be able to, buy good quality, hold it for the long term. And if given the $100,000 for an easy number, if you say, okay, I can stand a 10% downturn. Well, use dollars in that case. If I'm with 100, can I go down 10,000 or can I go down 50? If you say no, then we've got other alternatives that are going to be ones that don't go down nearly that much or down at all. Now it can limit the upside, but we can put it in there and say, no, we're never going to see a negative number, but we can get some good returns with where interest rates right now are for the upside. So that's where there's a number of different things we can offer, things that people can't buy on the open market on their own. But yeah, there's an awful lot of different ways that we can help out.
All right, well, we're kind of closing it up now. We have some closing thoughts, but more importantly, we have some Q&A, some great questions that have come in, and we want to get to those. So Bob, let's go over some of the closing thoughts we have for tonight.
Absolutely. Based on all the research we've gotten and what we hear, we think that the first half could be choppy, and a lot of that could be because of corporate earnings. We're seeing a lot of earnings announcements right now. Some are missing on earnings, some are missing on revenues, some are missing on guidance. A lot of CEOs right now will look and say, hey, our stock price because of this is going to be down 5%. Let's just throw the bad news out there that could be, whether we believe it's going to happen or not, but let's throw it out there. And instead of going down 5, we go down 7. But they've got the bad news out there. And then if that bad news doesn't happen, then they look like heroes 2 quarters down the road. So they're a lot of times throwing the baby out with the bathwater right now. We think that a lot of the bad news for bonds has been cooked in, that the Fed will only raise a few more times, or only should raise a few more times, and then take a wait and see. Let's see what they've done if that works. We're already starting to see inflation come down. Will it come down more if they just take a wait and see? And if so, will the bonds start to come back down? And if the Fed overdid it and they have to spur us out of a recession by lowering interest rates, that'll be good for bonds as well. So we think the worst of it is bad there. Hopes for a soft landing. We've had 17 recessions. 14 of them, they did not engineer a soft landing. We had 3 out of the 14, they've engineered a soft landing. Usually they overshoot or undershoot. And if they undershoot, that's a pivot. And that means inflation spurs again. We don't want that. We're hoping that they get the soft landing. I'm just not so sure. Also, we do have that silver lining. We do anticipate that we're out of the doldrums and through the storm and better off going forward. The third year of an election cycle is usually pretty good. mid fourth year, you get into another, presidential election cycle, Congress. So we'll have to wait and see. It's hard to predict 18 months out, but we do think that by the end of the year, we're going to be better off than we're at right now. And if not, we've got a lot of fixed insurance solutions that can majorly limit or avoid market losses, but still give some good upside potential inside of those.
Yeah, very good, very good. Excellent summary of 5 points. Now let's get into some of these Q&As that have been coming in. So we have, as I say, a number of questions that have come in. If you have a question, please email it in to 1azwealth@1azcu.com, and we'll be sure to address it. Okay, I'm going to bring up some questions that we got actually earlier today that I thought were very good. So I think they're worth repeating, and for those that are on this webinar today. And that is, first one, Bob, is with all of the announced layoffs, right? We've been hearing about layoff, right? I heard another one today. Why is the unemployment rate still going down?
Great question. Thank you for whoever asked that. The announced layoffs have been announced. They don't necessarily, and we've seen this in a lot of the tech areas, Microsoft and Google and Amazon, and today both Zoom and one other, eBay, announced layoffs. That doesn't mean that the people automatically lost their job right then. It's that they are going to lose that job or expected to lose that job. So it's maybe not in the unemployment rate numbers so far, because they're still getting their severance package. They haven't been able to file for unemployment. So that unemployment rate is still going down. And we're seeing jobs hirings go up. So we may start to see that in the next few months start to filter in. We saw unemployment at a brand new low just last week, announced at 3.4%, and total unemployment at 6.6%. That takes into place not only the people that are unemployed, but the ones that are underemployed, that may be part-time and want a full-time, or they're looking in their industry and can't find something, or have given up because they're not hiring in their area. But that 3.4 is the lowest since May of 1969. But a lot of it are service jobs, and service jobs are needed, but they're not always permanent. You look here with what's going on, a golf tournament, a big football game, the car show. There's a lot of people that were hired that their jobs next week or the week after aren't going to be there because they don't need the bus drivers or the waiters or, the security people. They'll move on to either other areas or just go back to, maybe they were part-time retired and took a job just as a host. Those service jobs may go away. The other are government jobs. A lot of times government jobs are regulatory or oversight or different things that they don't really produce a whole lot, so they don't add to the GDP. So that's where we've seen the unemployment rate going down. We've seen job hirings go up, but that could turn going forward in the near term.
Sure. All right. Another question is, are we in a recession or upcoming depression? Wow, we haven't heard that depression word for a while.
No, no, and a lot of people are saying, are we in, are we not, are we there? And again, that goes back to that National Economic Board of Revenue Review Bureau that says when it started, when it ended. I believe that we are probably in the beginning stages or middle stages of a recession. That'll come to fruition or to pass later. Depression, that's more economic policy and government policy related. The recession is a normal cycle. I think that we are probably in there. Time will tell. If we're not in there, we're probably heading to it. Hopefully it is a very light recession, not a big heavy one. It's kind of like, you can get a cold, you can get a little sniffle, you can get knocked down for a couple of days. Recessions can be either big or little. Let's hope for just the sniffles.
Yeah, for sure. All right. Do you think, next question is, do you think it's a good time for investing in domestic or international?
I do. If you're able to leave the money in there for 3, 4, 5 years, it's a great time for investing, even in stocks. And if you're investing through 401ks and IRAs and doing it through payroll deduction, keep doing that every 2 weeks or every month when you get paid. Keep putting that money in, even when it's lower. It's a good time continue, just keep putting in, get that match if your company's doing so. And I think it's a great time for high yield bonds, municipal bonds. I think those are great times to buy in. Domestic or international, I'd look more domestic. We're the prettiest house on a bad block for the economy. I think that domestic, with our dollar being very, very strong, we don't have what's going on in Northern Europe, what's going on in the Middle East with oil prices down low, what's going on in Southeast or Far East Asia. I think that it's better to be more domestic right now than international.
Absolutely. All right. How many more times do you think the Fed is going to raise rates? Well, I know we don't have a crystal ball, but all indications and a lot of economists are now giving some pretty good numbers. What do you think?
Well, and that's one of those where when Chairman Greenspan was in there, he was the only one that really spoke. He would come out and talk. Today, you've got all 12 of the Fed presidents that want to come out and talk. Earlier today, we were watching on the TV as Chairman Powell is out there talking about disinflation, and you've got the Minnesota Fed, Neil Kashkari, saying, we need to keep raising rates. We can't stop right now. There's so many different opinions. I am hoping that they'll do one more quarter point and then just take a break. Wait and see. Let's look at all of that. I joked earlier that, my wife always tells me, hey, 1 aspirin is good, 5 is not. Let's not over raise just because we can. Let's take a wait and see. These interest rate increases, or these Fed funds rate increases, take a while to be felt through the economy. Let's look and see what they've done and whether it's worked, instead of just continuing until it's too far in.
Yeah.
So I'm hoping 1 more, maybe 2.
Okay. All right. Another question is, what do we see as the biggest risk moving forward in the economy and the markets in 2023? So what's our risk issues that we're looking at?
Yeah, I still think that the Fed over tightening is one of the bigger risks. I think that we don't want them to kick us into a recession. We want lower prices at the pump. We want lower egg prices. We want lower, home prices, but we don't want to lose jobs to do so. And that's what a recession usually does, is cost people jobs. I would like those prices to come back down naturally when the excess money comes out of the economy. But I think that is one. I know that you had mentioned one earlier today that you were thinking as well.
I was mentioning, I think it's earnings. The big question is the earnings and how deep and how far down some of them may go. As you related to earlier, is that some companies will actually, when they know it's the markets, their earnings are going to be down. Well, let's just throw everything at it and make it even look a little worse, since we know everything is down. And that can, not be a good reflection of what the reality is. But I have confidence that we're going to pass through this, but it's just time. It's just time to get through.
And I think a lot of people are worried about the debt limit, but ultimately that will get resolved. There may be a short shutdown, but that is more, I think, for the kabuki theater of government, that they want people to notice it and want people to take sides. But I think that, we will pay our bills. We're not going to default. That would be economic disaster for, the world. But so I don't think they'll get to that. But you're right. The earnings, whether we have some issues there. But I also, heard that sales after Thanksgiving weren't as great, or Christmas numbers. But I think that could be individuals trying to keep a little bit of more cash in their pocket in case we go through a recession. And then if we don't get a bad one, then I think spending takes off again. We're seeing cruises right now.
We are seeing supply chains get back into order now, though, too, right? Yep. We're seeing, you can go buy a new car now, right? And the used car markets have already softened and so forth. So things
starting to see the advertisements for President's Day sales. So the furniture stores have stuff in their inventory again.
Yeah, exactly. Bob, there's been a number of questions that have come in. I'm going to say they're more personal in nature, really focused on their individual need or their individual situation. And I think we're going to take those offline and reach out to you individually for some of you, because it's really more of a personal item. We can't give just standard general recommendations, because there is always a lot of personal information as well as personal views and needs that we need to take into account when we make those recommendations or call outs. But I'll close up with this one. And the question is, how best can I stomach and manage this market volatility, right? Wow, what a year 22 was.
Yeah,
But how do
if
we
you were able
stomach
to
this,
stay in
Bob?
during that year, you can stay in for most any year. I think the most is have somebody, a sounding board, whether it's an advisor, whether it's a family member, somebody you can talk to just kind of, sound it out. A lot of times when it's in your head and you're worried about it, but just talking it through and talking with somebody that can give you an alternative view or just ask a question to make you rethink it. Just having an advisor, whether it's a friend, a family member, a professional, just being able to talk it out. Don't just keep it bottled in.
That's so true. So true. Absolutely. Well, listen, I want to say thank you. Wrapping up now. Thank you, Bob, for your presentation and insights. For those watching and listening, thank you for joining. We hope this discussion today has helped to provide you a better understanding about where we are today and what maybe tomorrow will bring. We here at 1AZ Wealth Management welcome your feedback and your comments. So please email us with any suggestions you have for a future webinar or topic you would like us to address. Okay.
Thank you, everybody, for attending.
Yeah. Now there's just always a call out that there's never a better time right now than now right now for a second opinion, right? On, as we just talked about, the volatility of issues and the concerns people have. It's important to get second opinions. It's important to get counsel and reaching out for good information. Many of our clients that have been clients of ours actually were clients somewhere else. They've come, they've listened, they've learned some new ideas, discovered some new strategies, and have been actually better suited with us. So I urge you to call us. We welcome your call. So please call their toll-free number at 877-566-0517. You can also visit our website, 1azwealth.com, for more information, as well as you can actually click on any of our advisors that we have and actually select a time that would be convenient. You can do it by conference call, you can do it by Zoom, or you can even schedule an in-person meeting. Again, I want to thank you all for joining. From all of us here at 1AZ Wealth, we wish you the very best for 2023, for your safety, your health, as well as your wealth. Now, the additional slides that I'm going to be showing here actually contain references of disclosures of the materials and the charts that we presented. If you have any questions about the charts that we presented, or you'd like to know where they came from, please reach out to us and we'll be able to share more details for you and with you. So here are some of the additional disclosures from some of the different firms. We pulled together a number of information from different sources that we have available. So again, as wrap up, I say thank you very much for your attendance. Look forward to seeing you in the March webinar when we're going to talk about those 11 mistakes people make with IRAs, and also a little bit about the Secure Act 2.0. But again, thank you again. I wish you the very best. Take care and good night.
Have a good night. Thank you all.